Imagine you invest $10,000 at age 25 and you never touch it. No extra contributions, just one deposit. By age 65, depending on the return you earn, that single investment could be worth anywhere from $48,000 to over $300,000. The difference between those two outcomes isn't skill, timing, or luck. It's one number, the rate of return. And the reason the gap is so enormous isn't arithmetic. It's something else entirely. Something Albert Einstein allegedly called the eighth wonder of the world. By the end of this video, you'll understand exactly why compound interest is the single most powerful force in personal finance, and the specific mistakes that prevent most people from letting it work. Let's start with the mechanics, because most people think they understand compound interest, and then they underestimate it by an enormous margin. Simple interest means you earn returns only on your original principal. You invest $10,000 at 5% per year. You earn $500 every single year, forever. After 40 years, you'd have $30,000. Compound interest means your returns earn returns. That same $10,000 at 5%, compounded annually. After 1 year, you have $10,500. The next year, you earn 5% on $10,500, not on $10,000. That extra $25 sounds trivial. But repeat that process for 40 years, and your $10,000 becomes $70,340. That's more than double what simple interest produces, from the exact same starting point and the exact same rate. The difference is just time, and the reinvestment of returns. There's a shortcut that makes compound interest intuitive, and it's been used by investors and bankers for over 500 years. It's called the Rule of 72. Divide the number 72 by your annual rate of return, and the result tells you roughly how many years it takes for your money to double. At 6%, 72 divided by 6 equals 12 years to double. At 9%, 8 years. At 12%, 6 years. Now think about what that means over a long horizon. At 9% returns, money doubles every 8 years. Over 40 years, that's 5 doublings. 1 becomes 2, 2 becomes 4, 4 becomes 8, 8 becomes 16, 16 becomes 32. So $10,000 at 9% over 40 years would be approximately $320,000. And crucially, the last doubling adds as much as all the previous doublings combined. That's the geometric nature of compound growth. The longer it runs, the more disproportionate the final acceleration becomes. Let me make this concrete with a comparison that surprises nearly everyone who sees it for the first time. Meet two investors. Investor A starts at age 25. She invests $5,000 a year for 10 years, a total of $50,000, then stops completely and never adds another dollar. She just lets it sit. Investor B waits until age 35 to start. He invests $5,000 a year for 30 years, a total of $150,000. 3 times as much money. At age 65, assuming 7% annual returns for both, who wins? Investor A, who invested $50,000 early, ends up with approximately $602,000. Investor B, who invested $150,000 late, ends up with approximately $504,000. Investor A wins by almost $100,000, despite investing a third as much money. She wins for one reason only. She started 10 years earlier. Those first 10 years were the most important 10 years of a 40-year investment period. Here's the insight that case study is really pointing at. When people think about building wealth, they almost always focus on two variables: the amount they invest and the rate of return they can earn. They save more, try to pick better investments, look for higher yields. But the third variable, time, is almost always underweighted because it doesn't feel like an action. You can't do anything to create more of it. You can only stop destroying it. And the way most people destroy it is by starting late, waiting until income is higher, waiting until debt is paid off, waiting until the market feels safer. Every year of delay has an asymmetric cost because you're not just losing 1 year of returns, you're losing 1 year of compounding on every future dollar. At 9% returns, a single year's delay on a $10,000 investment at age 25 costs you approximately $148,000 by age 65. Not $900. $148,000. That's what 1 year of waiting actually costs. Warren Buffett is the most famous example of compound interest at work over a long career. But there's a detail about his story that almost nobody talks about. Buffett is worth over $140 billion, and roughly 96% of that net worth was accumulated after his 60th birthday. He was worth about $1 billion at age 50. He became a $100 billionaire in his 80s and 90s because he started young and kept going. He bought his first stock at age 11. He never stopped. If Buffett had been a typical professional investor, starting at 22, retiring at 60, financial analyst Morgan Housel has estimated his net worth would be roughly $11.9 million, not $140 billion. Same skill, dramatically shorter runway. 99.9% of the wealth disappears. Buffett himself has said his success comes down to three things: living in America, some lucky genes, and compound interest. The last one is available to everyone. Now here's something that rarely makes headlines, but has an enormous impact on compound growth: fees and taxes. A study by mutual fund research firm Morningstar found that the average actively managed mutual fund charges roughly 1% per year in expense ratios. That sounds harmless. But over 40 years at 7% returns, the difference between a 1% annual fee and a 0.1% fee on a $100,000 investment is approximately $220,000 in lost wealth. The fee doesn't compound, but what you would have earned on that fee does. Every dollar you don't pay in fees is a dollar that compounds for the rest of your investment horizon. The same principle applies to taxes. Unrealized gains compound tax-free. Realized gains get taxed in the year of the sale. This is part of why long-term buy-and-hold investors structurally outperform frequent traders even at identical pre-tax returns. The tax deferral is itself a compounding advantage. So what are the patterns that silently kill compound interest before it can work? The first is starting late. Every year of delay has an exponential cost, not a linear one. The second is interrupting the compounding, cashing out investments for short-term needs, paying down low-interest debt with money that could compound at higher rates, or stopping contributions during market downturns. The third is high fees, paying 1 to 2% per year in fund expenses or advisory fees without understanding the long-run cost. The fourth is tax inefficiency, trading frequently in taxable accounts, realizing gains that could have continued compounding. And the fifth, perhaps the most ironic, is over-optimizing for rate of return, while ignoring the other two variables. Chasing the next hot fund, switching strategies every few years, paying high fees for active management that underperforms the index. Sometimes the boring, low-fee, long-held index fund quietly beats almost everything else, not because of genius, but because it lets compounding run without interruption. The solution to most of these problems is less exciting than people expect. But that's exactly the point. Start as early as possible, even if the amount is small. A consistent $200 a month, started at 25 at 7%, grows to over $525,000 by 65. The same $200 a month started at 35 grows to about $243,000. Same contributions. 20-year Head Start produces more than twice the outcome. Use tax-advantaged accounts first, 401k up to the employer match, then an IRA, then taxable accounts. Every dollar of tax you defer is another dollar compounding. Keep fees low. In the long run, the difference between a 0.1% index fund and a 1.2% active fund is measured in hundreds of thousands of dollars, not percentages. Don't interrupt the process. The biggest risk to compound interest isn't a bad year in the market. It's selling during a bad year in the market and losing the recovery on the other side. Let's bring it together. Compound interest isn't complicated, but it is counterintuitive. The gains feel invisible for years, then suddenly become enormous. The cost of starting late feels painless until you run the numbers. The drag from fees and taxes feels small until you see what they cost over 40 years. Warren Buffett's story isn't really a story about stock-picking genius. It's a story about starting young, keeping costs low, never stopping, and letting time do the work that no other investment strategy can replicate. Einstein may or may not have actually called compound interest the eighth wonder of the world, but whoever said it understood something most investors don't act on. The math doesn't reward the smartest investor. It rewards the most patient one. This video is for educational purposes only, not financial advice. If this helped you understand how compound interest really works, subscribe for weekly breakdowns on wealth-building principles